Hello everyone, Mehdi for Tokyo Alpha Mind and welcome back for another video. So today I wanted to talk about the Japanese yen because I'm sure that some of you, or many of you actually earn or have Japanese yen. And so the point that I wanted to discuss today is that it will actually be a good idea to try to diversify away. So there are actually quite a few reasons for that. And this is what we're going to discuss today. So the first one is actually that diversification is actually good just by itself. It reduces your exposure to one single, I would say, point of value, and also it reduces the volatility in your portfolio and your assets. But having said that, so the point about Japanese yen is that in the last 3 decades, the Japanese government has increased the debt quite significantly, as you may know. So today, debt level for Japan is around 250% of GDP. So many have said that yes, the debt is owned mostly by Japanese. This is true, but the reality is that it is owned by Japanese institutions. Japanese households and Japanese individuals are not that stupid actually to purchase the Japanese bonds with very low interest rates or very low, I would say, yields. So that's why today most of the institutions having those, especially those long-dated Japanese government bonds, they are insurances, banks, and pension funds. So these are the most or the biggest holders, I would say, outside of course, the Bank of Japan. So the Bank of Japan owns more than 50% of all the Japanese government bonds. So more than 50% of Japan debt. Why it's important? It's actually very important to understand the relationship with the central bank and the Japanese government. So Japanese government issues what we call Japanese government bonds. So this is how they finance all the deficits and all the spending. So in Japan. And the Bank of Japan is managing the money of Japan, so meaning Japanese yen. So what about inflation in Japan? So basically for the last 30 years, after the bubble burst, we didn't really have inflation in Japan. So which means that the prices that didn't really change for almost 30 years. Well, it's actually not really true. Like prices, they kind of evolve. They kind of increase a little bit, but before COVID, I would say that most companies were very reluctant to increase the prices. And what we've experienced after COVID is actually twofold. So first, the yen kind of devalued. So which means that we had a lot of influx of tourists coming with much stronger currencies, and this has pushed the prices of hotels, prices of travel in Japan much higher, and it has become very unaffordable for people in Tokyo or people in Japan actually to basically travel in Japan. So very hard for Japanese. And we had also so just after COVID, we had this kind of inflation linked to the supply chain. And what happened is that a lot of companies, they realized that, because inflation were kind of accepted within the Japanese, I would say, society, that they started to raise the prices. And basically, it happened slowly, but I show you, most companies, they started to actually increase the prices. And we continue up until this day to see that every October, every April, like prices, they kind of increase. And so there is this kind of sticky inflation in Japan. And I think this is very, very dangerous because we are in a situation, as I said, with a lot of debt and with a very sticky inflation and not a lot of growth in Japan. So what do we call that? We call that stagflation. So which means that we're not going to get a lot of economic growth, not a lot of room for more stimulus from the Japanese government, and a lot of inflation coming from basically two things: stronger currencies outside of Japan, so meaning more expensive imports. And the second thing is that a need for the Japanese government to get inflation. So to increase the monetary size just to be able to reimburse its debt. In Japan, I think this is very important for everybody to understand, and as well what's the future for the Japanese yen. So the first thing is that, as you know, like the level of debt in Japan is actually quite high, around 250% of debt to GDP ratio. And this is how we measure the level of debt for, I would say, countries. So one thing that you have to understand is that as of today, Japan is in a pretty difficult situation. Why? Because it has a very high level of debt. So that's one thing. But it also has very low interest rates, and it has very low growth. So which means that if you want to stimulate, if you want to create more growth, you will need more spending from the government. So this is what we call fiscal stimulus. And the problem with that is that Japan has already too much debt, especially for foreign investors. So they consider that Japan has too much debt. It is true that most of the debt is held by Japanese, but actually it's held by Japanese institutions. So foreigners hold around, I think around 15% of all the JGBs. And the biggest holder of JGBs is actually the Central Bank of Japan. And this is where it becomes very interesting. It's interesting because as of today, no one wants to buy those JGBs, especially foreigners, because they are very low yielding. Well, actually, the yield on the 30 years bond is 30%. It's not 30%. It's 3%. Sorry. Even though the coupon rate is actually much lower. And the fact is that people are becoming more and more concerned with the situation in Japan, and the fact that there is no real path out of this debt situation in Japan. Well, but if you think clearly, there's actually one path, and which is about inflation and the devaluation of the Japanese yen. Why? Because the debt that is held today is not going to grow nominally, meaning that if you 100 Japanese yen today, then in 30 years, you will have to give back this 100 Japanese yen. And so the way to get out of this is to inflate to the debt, meaning to get inflation. So inflation is going to increase the revenue for the government while keeping the level of debt stagnant. And so that's why we are seeing today more and more inflation in Japan, especially driven by two components. So first, devaluation of the yen, meaning that imports are becoming more and more expensive, which are driving the prices in Japan for all the imported goods. And second, an increase of the monetary mass in Japan, driven by the BOJ, because the BOJ cannot stop printing money to buy the Japanese government bonds. And basically another point about Japanese growth and the need for stimulus. So what we've seen is that, well, obviously in the last decades, Japan has not been very good into developing the software industry, and I think it's going to be the same for AI. So today Japan doesn't really have like a very strong industry for the next decade. So it's going to be very hard for Japan to actually get a lot of growth. And as well, they are kind of entangled in this tariff wars, where all their main industries, like the automobile industry, they're kind of caught up into the tariffs, and it's going to be very hard, for example, for like Toyota or Honda or Nissan to actually grow even more, as we have Chinese players which are very good in terms of EVs and are very strong competitors for all the Japanese players. So all of that just saying that growth in Japan is going to be very hard, and there is not so much space for additional stimulus. Very hard for Japan to raise the interest rates above what they are today. So today they are at 0.5 basis points. This is obviously for the short end of the yield curve, meaning that the short-term interest. But having said that, like they are trying to push higher, but they basically cannot. There is way too much debt into the system for them to raise significantly the interest rate. let's come back to the Japanese yen. So what's the impact on the Japanese yen? So the first impact is that Japan is not going to raise significantly this interest rate to compensate for the devaluation of the yen. So if you take the difference of interest rate between Japan and other countries in the world, this is one factor of the fact that Japanese yen has become much more and more, I would say, cheap compared to currencies like the US dollar or the euro. So what we are seeing today basically is that, okay, so they cannot reduce the interest rate spread between the Japanese yen and those currencies. So Japanese yen is staying very, very weak. Another concerning actually development is that more and more investors are not really seeing the Japanese yen as a place of safety. And the Japanese yen remains weak even in those turbulent times. So which means that more and more investors, they want to move away from the Japanese yen because they don't really consider it as a safe asset. And this has really come as well from the government, because what we've seen is the yield on the long Japanese government bonds rising or increasing a lot, I would say. So more than 3%. And why it's concerning? Because this means that people, they expect more inflation in Japan, and they expect or they demand more returns for the Japanese yen on the long run, and much more than the 0.5% that we have on the short term. And so all this situation is actually leading me and many people actually to understand that even though the Japanese yen is quite devalued today, it's going to continue. This is definitely going to continue. And there are major risks because there is no real improvement path for either the BOJ or for the Japanese government. So they are in very tough situation, and the only, I would say, path out of this situation is to continue to devalue the yen and to let inflation run away. And this is not very good for investors like me and you, especially if we hold Japanese yen. So that's why I would kindly advise to actually diversify away from the currency. So that was all my sharing for today. Well, thank you for listening, and if you have comments or opinions, just put that into the comment section, and see you into the next one. Bye.